No, there you go. All right. So this man's been pretty vocal already, so let's put him on the spot. I'm going to ask Jerome. Team Asia, can you give me some insight, given you were given that amount of information, can you give me some insight as to how your team thought about building a portfolio in this environment?
Oh shit, I wonder what we did. What did we do?
No swearing. You're on camera.
We knew we were worried. The thing we were worried about happened. You've got to be careful what you focus on. Well, look, we just... I don't remember what the scenario was.
Okay, so you 25% Aussie equities, 40% global equities, 12% Aussie bonds, 23% global fixed income and no cash.
Yeah, well, I think part of it, our team discussion was around, look, we've had a de-rating within equities, so we thought we'd been through a pretty tough period. Usually they don't last that long. Valuations were now reasonable. GDP growth, inflation seemed okay. Cash rates have been going up, which sort of led into the thing that, growth had been strong. We sort of come out the other side of it. Volatilities didn't particularly bother us that much. Returns had been good in equities though already. There's obviously momentum with that, arguably, short time frame. So we thought, look, let's go a little bit over on equities. We still think bonds should do okay, so we went 65-35 and sort of thought, we didn't really have high conviction on and we thought global probably better diversification than Aussie or whatever, and didn't have a lot of conviction around any of that. So we wouldn't be surprised though. We were very clear that we might be shocked because that's the nature of what, Schroders would probably do to us, right?
Is that a good way to run a business, to be shocked?
Yeah.
Are you feeling confident?
No.
No? Okay. That's probably a good place to be. Long Sterling, where's Long Sterling? Long Sterling, who wants to tell me how they thought about building a portfolio?
Not really, but...
So this is the other side of the equation. So 20% risk assets, 40% Aussie fixed income, 20% global fixed income and 20% cash.
After
Very different portfolio.
Yeah, so we were trying to pick what time in history we thought this equated to, and the Reserve Bank putting up rates. So we went straight to the Reserve Bank website and tried to work out when they put up rates 5 times. And we came up with 2007, which may or may not have been right, because there were a couple of times in history where they'd done that. But based on the PEs and the return profile, we being a bunch of geniuses that we are, we thought 2007 was about right. So we thought that was just before the GFC, wasn't it? So we decided to reduce our equity exposures quite dramatically, and we only had, I think, 20% in equities and the rest in bonds and cash.
Okay. With what I've just put up on screen, do you feel confident?
Yeah, that looks better.
All right. You were pretty correct. Period was 2006 to 2008. Jerome, you feeling confident? He's gone quiet. Okay, again, apologies for the colour. It's a little bit faint. Emerging market debt. No comments. Okay, so if we bring up that was last place, just to not dwell on the point. Balanced portfolio. Team Beta shares, who have all left the building. Sponsor table and they've all walked out, eh? Anyway, Team Beta shares just went passive. Funny that. Very, very slightly different portfolio, but ultimately passive allocation. The median manager was Team Global. So this is the average of the room. The average return of the room was Team Global, with 45% in Aussie equities, 2% Aussie fixed income, 15% global equities, 5% global fixed income, and 33% cash was the average of what you all thought. The wonderful definition of median fund managers. Now, I have heard a few rumours. So one of the reasons why I'd love to fire these people, but anyway, one of the reasons why I only give you 10 minutes is obviously if you work the period out, it gets a little bit easier. Now, tell you a little story. At the i3 conference, which is, as I said, the who's who of the institutional industry, there were 5 people from the Future Fund. One of the key people at the Future Fund was absolutely certain that they picked the period. was quite vocal about it, and they got it completely wrong. So be very careful about picking the period, but I am calling conspiracy because some of these allocations look a little bit dodgy. So, team leverage. %, fixed income. So clearly they get the drawdown and the volatility score quite well, and obviously if you pick the period with that type of allocation, you're going to do well in this kind of game. Team hybrids. Where's Tony when you need him? He was late and he's left early. I was going to abuse him, but 40% global fixed income, 60% cash, at least being a little bit more active and a little bit more thoughtful than team leverage. But clearly this round we have shaken the leaderboard up. This is financial crisis. Clearly we got a reasonable drawdown, but here come the implications. 13 out of 25 teams have been fired. So one of the objectives, and maybe I need to make this a little bit lighter, but one of the objectives is not to experience, if you look at the third column across, more than a 20% drawdown. So, I'm sorry, this is actually, well, I'm not showing you, if I show everybody, don't look too quickly, 13 teams, including the passive balance portfolio, got fired. We all know what happened in the financial crisis. We all know what the implications were. Thankfully, no one underperformed the median manager. It's quite interesting when you do median type analysis. No one underperformed the average of the room by more than 5% in return terms. But this game is a game about return as well as risk. Risk as well as return. And team leverage with 100% fixed income went from near the bottom of round one to the top of round two. That's quite a phenomenal score, obviously, but we'll see how we go in round three. So, clearly 2006 to 2009, February 2009 was the trough of the financial crisis. So, with bated breath, I will turn that on so that you can view the results at your leisure on your own devices. I will make a few comments. One of the things, and clearly we've got we've had a lot of debate about some of this already in terms of retirement solutions, sequencing risk. But anyone who knows me, and there's a bit of a joke on our website, but I am the proud father of 4 daughters. My wife recently had a son, and apparently, so I've got 5 kids, if anyone knows a good financial advisor, I need one. My son, apparently, according to Time magazine, is going to live to 142 years old. This is quite serious in implication. Maybe it is a bit of sensationalism, but we are living longer. We have come out, or we are coming out of a very strong bull run in markets. There is an argument to say that markets globally are looking pretty expensive, and we're in an environment where we need to ultimately make our money last longer ultimately there's not a lot of return in order to be able to do that available to us at the moment. So it's a very interesting market. So the debate, obviously, in retirement, and there's a whole other presentation behind this in terms of retirement solutions and how we're thinking about it, but you either need to take more risk, leverage up. That typically doesn't end that well. You need to use more efficient skill, or take more efficient risk, or ultimately use some skill. So we are in that kind of world where, certainly at the moment, I would be advocating for the active camp, and we can debate that later. In terms of the typical balance portfolio, one of the things, I'll show some, it's a shame that Tony left, because clearly we have a view about what the world's going to do going forward. We have forward-looking return expectations and views, but one of the things that I will give absolute certainty to is that we will be wrong. Return forecasts are point estimates. What's really important is actually the distribution of those return estimates and how you think about the return distribution. So every asset, whether it be a stock, whether it be an asset, whether it be any type of investment that you invest in, there is a distribution of returns around it. And one of the focuses, and one of the reasons I'm drawing out drawdown, is focusing on the drawdown risk, not just volatility of the assets, is very important. So if you look at a typical balanced portfolio, you get a wide distribution of returns, you get a lot of cyclicality around that target. And depending on what your view is, but maybe we're at the top of one of those cycles now. What we try to do with what's referred to as objective-based investing is try to tighten the distribution. We're trying to target a similar kind of return objective, but do it with less volatility. So what we're trying to do is smooth that path, but ultimately achieve a similar kind of objective, and then you can do it in different ways. You can target a lower return, tighten the return, or the certainty even further. One of the things to draw out, I mean, Tony talked about forward-looking forecasts. We're talking about passive. This is something that lots of people are very focused, and I've talked a little bit about bonds and the forecast on where we are in the bond market. But clearly, if we get a market correction, it's not bonds that you need to be worried about. And in fact, the bond market is, despite our low return forecast, is not where we're particularly concerned. The reality is, if you have today, if you're passively, everyone knows this but keeps forgetting it, if you're passively invested into global equities today, 60 cents in every dollar is going into the US share market. It wasn't that long ago that 44 cents in every dollar in global shares went into the Japanese share market. Today, 25 cents passively invested in Australia goes into the banks. 9 cents goes to the CBA. Well, it did. The reality is today we go through cycles, and if you want to be diversified, 60 cents, obviously, you've got to have a view that that's going to get better from here. But clearly, this is the magnitude of drawdowns since the 1900s, and there are some, including the financial crisis, there have been some more significant ones. We are at the end of a massive stimulus cycle. This is effectively the magnitude of QE. What you're seeing on this slide is Fed balance sheet, the Bank of Japan, ECB, it's a bit old now. Fed, everyone knows this, Fed's tapered and stopped. We're now grappling with the unwind. Everyone is very focused on the US, i.e. what are they doing? Raising rates, the market's priced in, raising rates. But when will they start unwinding this balance sheet? Will they ever unwind this balance sheet? The big bogey in the room, though, is the green line. Sorry, no, the blue line, the ECB. Everyone's very focused on the US, but really it's actually what Draghi's doing that is going to change the dynamics of these markets. As we start unwinding QE, unwinding this stimulus going in the other direction, it has fairly significant implications for markets. This is basically, if you think about return forecasting, every asset's pretty simple, right? Whether it's a share, whether it's a bond, whether it's an asset class, typically assets are made up of a yield component, a growth component, and some kind of valuation component. If we look back over the QE era, those effectively seven years, obviously you can take this a little bit longer now, you can see just how stark the difference was between the Aussie market. We often get asked about why Aussies underperform. Well, number one, it started at a lower starting point. Sorry, a better starting point because we didn't have the recession that the rest of the world had. But what you can see there is that income component versus the US income component. We know that we're a high-yielding market, but really the biggest driver of returns in terms of that QE era has been a re-rating or a willingness to pay more for the same stream of earnings. If we go back, so I had a video for him as well. If we go right back, one of the beauties of working for a business like Schroders is we've been doing this for a long time. This is effectively what the world looked like on the 30th of June 1998. These are our views, our forecasts for the major assets that we can get exposure to from Australia. And what you can see there, blue is effectively equity exposure, and the green is the bond exposure, yellow being diversifying credit type exposures. Now, if you just watch this video, one of the beauties of having this and having technology is we can look at how return forecasts change through time. One of the points I make about this chart is we don't wake up tomorrow and simply decide that emerging markets are cheap. Markets move gradually. we need to gradually move and be active in not only our stock decisions, but also our asset allocation decisions. As you can see that video, as we went through the depths of the financial crisis and out the other side, everything became cheap. February 2009, it really didn't matter what you bought. Anything that you bought would have delivered very strong returns. And in fact, when you've been through a 30-year bond compression, what we've seen is it really didn't matter whether you were defensive or growth in terms of your asset allocation decision. Bonds have performed very well, shares have performed very well over the last 30 years, and so it didn't really matter how you were asset allocated. Going forward from today, with bond rates at zero or delivering negative rates of return around the world, we need to think very differently about how we're building portfolios, which is why we play this game. If we look forward to break down where that chart concluded, this is our view of where we are today. This is again looking at the Australian market versus the US market, and again you can see this. You can be very bearish about the Aussie market, but this is a very high yielding market. Right? You might be bearish on the banks, but they do pay attractive dividends, and it's unlikely that they're going to get cut significantly. So once you add franking, you're in a nice starting point in terms of your yield component. In a low return world, that yield component becomes a much more important piece. And the point was made earlier that the active management component also becomes a more significant piece of your return. Basically what this says is yield plus growth. Growth's around the same, we believe, in terms of the two markets. Again, you can kind of debate that. Long-run valuation for Aussie, we're about fair value, but the US market, Schiller PE type concept is expensive. Right? If you look at it, it's very high correlation with forward-looking returns, but over a long period. And that's the point. Over a 10-year period, ultimately, what you then need to do is adjust for the cycle. And so that's what that cyclical valuation does. It brings us into a short run or a shorter run view being a 3-year view. Now, if you look at the the Aussie market, 6.9 might be better than 0, hopefully. But 6.9 is also less than 10, which is the long run return for the Aussie market and has been for the last 100 years. So we're also bearish on Aussie. But Jerome said, who cares about Aussie equities? Well, we do, because we would much rather have our equity component in Aussie, given this, than in the US market that isn't even paying us an equity risk premium. Now, it's not that we don't own stocks in the US market, we do, but we're very selective and we are massively underweight in terms of an asset allocation decision. If I summarise that chart on the left-hand side in here, which is the end of that video, basically every asset that we look at the moment, and you can call this bearish, but at the moment, our return forecast, our view of the world, says that there's very few assets available to us that will give us that inflation plus 5 portfolio. So maybe, you know, the poor man's put option, maybe actually cash is a good place to be. But very importantly, on the right-hand side, it's not just about the forecast, it's about the dispersion. You might get a similar return forecast from emerging markets to Aussie equities, but the range of the outcomes. If we have a sell-off, emerging markets are the ultimate risk asset. So, with that, doom and gloom, round 3. So, round 3 gets a lot harder. You now have 10 assets to talk about. You have small caps. You know, whether it's worth paying performance fees on the alpha that you get in small caps is debatable, but one thing I'm doing for you here is actually not putting any performance fees or any fees at all in this debate. So you can pick small caps for free. Not possible, obviously, in the real world. Listed property, global equities, I'm adding currency here. So the Aussie dollar now becomes very important. Aussie dollar, hedged or unhedged, you can pick your currency decision. Global fixed income and the diversifying asset of global high yield. Conscious of time, start discussing 10 assets to pick from. You've got 5 or 6 minutes to build a portfolio to determine round 3, and then we'll come back with the results and the results of the overall winner. Good luck.
is died in the battery, so I'm just looking.
That's all right. Yeah, yeah, yeah. Okay, if you go to round 3, it'll now be live on your computers.
How do I log in and say that this is us?
Yeah, so don't do that. Oh shit, this is. Can I charge a computer? I've got PowerPoint. So the problem is what it won't. One of the bugs in the system. Well, it's not bug. It's actually there intentionally. Is you can't start from round 3. You can. Oh, actually no. You might be able to. Try it. Go to round 3. Don't log in. Round 3. Type as long as you get that name exactly the same. So you were.
No, I wouldn't be.
I think you changed it. I have now. So if you refresh round 3. It's all right. Yeah, so just make sure you get your name exactly. It's exactly that, Hybrid Securities, with a capital S, and then it should work. So one of the, I'll tell you a story when we did this for the industry fund audience. We were quite keen to add another asset, which is the proverbial unlisted asset. So we wanted to be able to add some of the assets that they can invest in unlisted property, airports, you name it, assets that don't price, that perform incredibly well. Needless to say, it's very hard to find any real data on any of that information. There is no index. We tried to create something out of private equity, try to leverage it, add commodities. Needless to say, we went back to basics and just stuck with the mainstream assets. One other point, if you don't know what you're playing for, because I haven't told you yet, this is it, right? We've gone from plastic to glass. Right, so every member of the winning team will have one of these to put on their desk. And maybe if you're lucky, I'll buy you a drink afterwards. Okay, we're tight on time, right? Oh, okay. When I fired 13 of you, I did this down in Talk E2, and as I said, well, I didn't say it, but one of the teams actually didn't come back. That's just a joke, right? You can play round 3. We're not firing anyone. Just makes it more interesting. But if you've experienced a 20% drawdown in this round, you're buying the drinks after this. Just conscious of time, probably got to close, yeah? All right. Just conscious of time because we had gifts to give away earlier. Maybe 2 more minutes to get your results in, and then we'll move on to the next session. You can still put your results in when the next session starts.